I'm Blaine Calkins, Member of Parliament for Red Deer Lacombe. I'm here with Graham Heron from MNP in Red Deer. We're west of Bentley right now on a family farm. We're going to talk a little bit about the proposed tax changes that the Trudeau government is proposing right now. That consultation period is happening during the harvest time right now. It's about to end on October 2nd, and I know a lot of people in the constituency, and being a farm boy myself, are really concerned about what some of these changes will actually mean if they were to come to pass and become law. So I'm glad that you're here to explain some of these things, Graham. So can you talk to us a little bit about what incorporated farms have done in the past insofar as, income splitting or sharing the family workload and sharing the income, or using dividends for things like paying for kids' education, and how some of these proposed changes will affect that practice?
Sure, and exactly the changes are in effect for the most part for family farms that are incorporated. So what we've got historically is the family farm. The entire family is working on the farm, and as a result they're entitled to share in the profits as they arise. So there's two ways to share in profits. You can pay salaries with the administrative burden of CPP and EI and source deduction remittances. So a lot of our clients and a lot of farm families basically are going, let's figure out what the profit is at the end of the year, and then we'll divide it up based on effort or the will of the family.
Right.
So the changes to income sprinkling, or income splitting as we call it, the government is saying, no, we're not going to allow family farms to split income on a basis that they deem reasonable. It's going to be a reasonableness test based on what the government deems reasonable, or the Canada Revenue Agency, which has an administrative burden all its own, because now the family farm, they're going to have to keep records as to who contributed capital, who did labor, who assumed risks.
So somebody going out and doing chores or something like that, they're going to have to keep track of that?
They're going to have to keep track of effort, capital, risk, and prior remuneration, dividends and salary. So there's an administrative burden for something that's really a simple question of who's done the work on the farm and who should be paid. And dividends historically were something that could be paid without these overarching tests of reasonability or deductibility, because dividends are not deductible. The corporations had to pay tax, and after that tax, the dividends are paid from after-tax corporate dollars into the family members.
So you're talking about tax integration right now, which means that basically everybody pays the same tax rate as it is right now.
Exactly. If you take a salary in Alberta, the top marginal rate is 48%. If you're operating a family farm corp, eligible for the small business deduction, the corporate rate's 12.5%. The dividend rate at the top is 41%. So when you take the 12.5% and the 41%, you get 48% as well. So it doesn't matter whether you take a salary or you take a dividend. You're basically paying the same rate of tax. So now the issue becomes, with income splitting, they're saying people are taking advantage of the lower rates of tax of family members who are involved in the farm to pay a lower rate of tax than if it was paid all at the top rate.
Well, we all know that family farms operate, they're called family farms for a reason. They operate because the whole family chips in and pitches in. It was a farm effort. I grew up on a family farm. I started doing chores at the age of 9. I was driving a tractor around. I was, doing whatever needed to be done, feeding the calves. And I know that those rules already apply. You can't sprinkle that income or share that income with anybody under the age of 18 already. So what age group was affected by this, Graham?
Well, the age group, the surprising part is the changes in 1999 brought income sprinkling or income splitting to ages below 18. You couldn't income split to a minor. After 1999, you still could income sprinkle or split with 18-year-olds and over, and with adult family members. Yeah. These new changes are basically saying anybody who's connected to the corporation is now going to be subject to the test of reasonableness on their dividends, regardless of whether they're below 18 or whether they're 55 or 60. Worse yet, these rules specifically target an age group 18 to 24, which is the university age, where students are going to school. In the farm family context, they may be going to Olds College down the road studying agriculture so they can improve on the farm to take in the new technologies that farming has become, a very technological industry. So the children of the family farm will work on the farm all season, work in seeding, work in harvest, work through the summer, but then they go to school. These new rules are saying in order for a dividend to be allowable at the child's marginal rate, 18 to 24-year-old, they have to work substantially and continuously on the farm. Otherwise, the income is taxed automatically at the top rate. Very punitive.
And let's face it, most people are deciding whether they're going to take over the family farm between those ages of 18 to 24. And we'll get to how that's going to be affected in a few minutes. But right now I'd like to ask you a little bit about passive investments and how will farm families be affected under the proposed tax changes?
Well, there's two key reasons or two key areas where passive investments will affect the family farm corp. The first one is on a running basis. So farms need to expand. They're hugely capital intensive. Yeah. Land in this area, pick a number. A quarter section of land is going to go anywhere from $500,000 to $750,000.
If not a million.
If not a million. This is prime farmland. Yeah. So to invest in that land, a lot of farms don't have $1 million in the bank. No. It takes several years to build up that kind of capital. And aside from financing, a lot of businesses, farms in particular, will accumulate capital year in and year out with a view to expanding when the time is right, when the right land is available. Now what's happening with these passive income rules, they're saying if you don't deploy those funds that you've retained in the company, in the business, instead you invest them in GICs or in passive investments, that income is going to be subject to an additional non-refundable tax in the corporate level at 50%, effectively taking away the ability to save funds to reinvest in the future.
To invest for more land, for more equipment, to expand the operation, whatever the case might be. The government is basically saying they don't want you to save your money.
They're saying that saving money within a corporation is bad. You should take the money out, pay an additional 40% tax, so you have 40% less to save, so that everybody is on a level field, ignoring the fact that businesses, family farms in particular, are hugely capital intensive.
Yeah, capital intensive and hugely exposed to risk. You don't know if you're going to have a bad weather year, you don't know if you're going to have a BSC event or anything like that. So having a little bit of money in reserve always makes sense to begin with.
Exactly, and that's the prudent business person model. In years when they're good years, you put money away. For the years when they're bad.
That's right.
So you can't continually go to the bank and say, oh, we had a bad year this year, our crop got hailed out, can you finance us for next year? Banks expect the farm family to put away funds to carry on the operation, and that's how farms are successful.
Yeah.
So this risk of carrying on investments and having them taxed at a super investment rate will actually restrict the ability of family farms to expand and to continue.
Unfortunate. So one of the other things that I'm hearing a lot of, and this is I think the thing that is most emotional for me, I remember the day that my dad and I sat down and we made the decision that I wasn't probably going to take over the family farm. And that's a really tough decision, because if you go down a road around here, you'll pass a number of farms that have the 100-year family farms on them with the name of that family that's been there, and that's several generations. And my father got his farm from his father, who got his farm from his father, and so on. You can go back down that road. Many family farms have that type of history. So can you explain to us what the proposed tax changes that the Liberals are proposing for families who want to pass that family farm on to their children? What's that going to look like now?
Well, there's two aspects to that. There's the capital gains exemption changes, and then there's the changes to what we're calling corporate surplus stripping, which, as the publications are saying, or as the commentary out of Ottawa is saying, these family farm effects are unintended. Unintended or not, the legislation is clear that what will happen if you try and sell your family business to your offspring, your children, there's a punitive tax effect of 40% higher than if you sold to an arm's length person. Now, the way this was explained was these rules were put in place to prevent stripping of capital from the corporation. So mom and dad are selling to their kids as a sham so that they could extract money tax-free from their company. But the rules that were put in place capture legitimate transactions. Mom and dad want to pass the family business on to the children. The only way for the children to finance a multi-million-dollar acquisition of the farm is to use the income from the farm. Now, the way that these rules are structured, they cannot use the income from the farm to pay mom and dad without paying an extra level of tax. So it creates a huge bias in the system for mom and dad to sell to the neighbor rather than to sell to their kids.
Rather than to pass the farm on to their own kids. And this is going to create a situation where those who want to take over the family farm are going to have to cut huge checks in order to buy into the family farm that they've already been working on probably for years.
Huge checks and huge tax bills in order to get there. And that's the one area where these provisions, they're saying they're unintended. But if they're unintended, the draft legislation makes no provision for an out, for grandfathering, or for protection for family farms or for family businesses. So legitimate transactions are being caught in a tax trap that's designed to catch very few and very small transactions.
Interesting. Well, it seems to me like the Liberals have had a ham-fisted approach in presenting this. I know a lot of people are very, very upset about this. Whether you're a doctor thinking about coming to Canada or starting up your practice in Canada, or you're graduating and you thinking about whether or not you're going to stay in Canada or go somewhere else, the changes are making it look like you're providing a disincentive for doctors to stay here. Small businesses are being treated like tax cheats, and farmers are being treated like somehow they're being tax cheats, when we both know that farming is a capital-intensive business. It's high risk for very low reward. Most people that I know actually have to work off the farm in order to provide a second income to support their farming operations. And these are the people that take care of our families when they're sick. The doctors, the business people provide the goods and services that we all need, and the farmers provide the food that feeds not only our nation but around the world. So these punitive tax changes are causing a lot of discussion. A lot of people are upset about it. But Graham, I want to thank you for explaining the ins and outs of it. I'll be doing my best down in Ottawa to pass along what I'm hearing from my constituents, and of course from experts like yourselves who have looked at it. And I want to thank you for taking the time to come out here and explain it to the people I represent.
My pleasure.
All right. Thank you.
Thanks, Blake.